Hey everybody, it's Mark Yagi. Welcome back to the channel. Man, my beard is long. Should I trim it? Put it in the comments if you think I should trim it. I'm probably going to trim it. Anyway, today is a weird day on Super Microcomputer. Now, remember, this is a stock that was amazing, and it went straight up all the way back. I think it was back in January. We actually put it on our list of stocks that we think could do incredibly well. We took some profit halfway in there, so we didn't get the whole move. We put out a video on September 6th, which was more than a month and a half ago, and said, this stock and another one, CrowdStrike, this stock, SMCI, is showing a pattern that portends it's a short. And they were having all kinds of accounting trouble and some weird stuff. So let me show you what the news is today, and then I'll show you the chart, and I'll show you what I saw back then and what I'm seeing now. So the headline, obviously, is Super Micro shares plunge 30% as auditor resigns after raising concerns. It also created a gap on the chart, which is generally not good, a downside gap. So there's some move to the downside going on right now. Ernst & Young resigned as Super Micro's auditor last week after raising significant concerns over the company's internal controls, board independence, and accounting practices. That's bad when a Big Four accounting company resigns from your job. That's a lucrative job. They were hit with short seller report earlier this year, and they delayed filing their financial statements. These are all bad things. Like, there's usually fraud or some malfeasance or negligence, at least, in the background. EY said its resignation letter, it was unwilling to be associated with management's financial statements. Like, you got your accountants that are like, I can't touch their financial statements. So it goes on to say there's a bunch of bad stuff. But, you know, the news is the one thing. But let me tell you what I talked about on September 6th. And that was, look at this chart, okay? So you could see this chart, you know, in January just went straight up from, well, it's all post-split now, from, you know, basically 35.70 all the way up to 122.90. What an incredible run. It was like almost a quadruple. And again, we took our profits some along the way, you know, like at the 700 level and then maybe a little bit higher. And then we got out of most of the position. And, you know, I wish we had on some of it because we could have ridden it all the way up to 122.90. So we didn't catch it all. I don't get to catch all the moves usually. I just try to catch like 80% of the move. So I got this one right. And then I started to see this weird pattern. A lot of gaps down on the chart. You could see one right there. You could see another one right there. And these are gap downs on volume, and that's energy to the downside. Gap down below the 50-day moving average there, a gap down below the 200-day moving average there, and then a big gap down here on energy. I think that, let's see, that was August 28th. And then we had, let's look at September 6th, which is the day I put that out. That was a swing point. Oddly enough, it was a 38.28 swing point. It was the bottom of what I was looking at as a dreaded H pattern. And then the stock rebounded a little bit, and then it had another high energy day there. So you can see that all the high energy days are to the downside. There's a couple bounces, but this stock was flirting with its 50-day moving average, and now it's well below the 50-day moving average. Look at this gap and look at this volume. Right now, the volume is showing it's 277% of its average daily volume. There's huge amounts of selling. The shorts are piling on. People are freaking out. The stock is dropping. It's down 32.74% right now. So if you remember on that video, I said the worst thing that you can possibly do is round trip a stock. And that means you buy it here at the breakout at 35.70. I put a red line right there. And, you know, you ride it all the way up, and then you're like, oh, I think it's a great company because it's associated with NVIDIA, and NVIDIA is a great company and all this blah, blah, blah stuff. But the sellers were there. So over time, I don't care if I'm right or wrong. I just want to make money. Over time, this thing has had a bunch of dreaded H patterns. You can see them all the way down here, and now it's made another dreaded H, and the dreaded H is a really drives to the bottom. Now, it's back down to the round trip level. It's back down below 35.70, which was the breakout point. Most stocks end up testing those breakout points at some point. This one just happened to take 10 months to do it or 9 months to do it. Now, where do you go from here? Well, we shorted it around $38.90, $39, something like that. So we're up, you know, a good percentage, not enough, but this kind of energy tells that it's going to go lower. So let's put it on a weekly, and I'll show you where I think it may go. Look at this weekly. It's testing this candle right here. So this bar right here was not a very high volume candle. It wasn't bad. It was 115%. But compared to the ones that followed, it wasn't that great. So what I'm going to do is I'm going to go back to the earliest candle. This is where I think it could go. It could go in down to 29.35 pretty easily. Now that's another 10%, 15%, something like that. And then if you shorted it anywhere like where this dreaded H that we were talking about was, you had to endure some pain. I'm not saying that I'm perfect. I'm saying that pattern was there, and then it bounced on pretty light volume. But now the news came in, and now there's no buyers to hold it up because they've all been selling. They've taken all these opportunities to sell. So this thing is loaded with sellers. Now, this is why a lot of people are like, well, Mark, why don't you do cash secured puts? Well, one of the reasons, I mean, it's not that I don't do them. I think it's a fine strategy. But if you did cash secured puts on this, now you might have done a cash secured put. Let's say the top of this candle is 49.70. You might have done a cash secured put at 45 or 42.50, something like that. And this stock is now at 33.47, and you did not have a chance. So now you own this stock, and everybody goes, whoa, when you do cash secured puts, you get to own a stock where you want it. You have to like the stock. And so if you like the stock and you were selling cash secured puts at 45 or 42, now you're wearing the stock 10 bucks lower, and the stock is in a drop, right? It's in a downtrend. So the problem, and I like the strategy again, but the problem with cash secured puts is you end up owning a stock that you probably don't want to own when you end up owning it. You know what I mean? Like, you don't want to try to catch this falling knife. This thing could go to 29 bucks, and that's just the next possible swing point. I think it also could go to the bottom of this consolidation. You see this consolidation here? That's a stage 5 consolidation. The bottom of it is right around $23. You think that you were happy getting your $2 or $3 or $4 a week or a month or whatever, and all of a sudden the stock now goes to $23 and you were at 45? Like, you're down 50%. Now it's hard to make up that money. So that's the problem I have with cash secured puts. It's a bullish strategy, and yes, when the stocks are going up, you just keep putting the juice in your pocket, and that's great. But then all of a sudden you have a gap down on a stock like SMCI, and now you're wearing it really low, and then you have to start selling calls against it to make money, and it takes a long time to make back up your money. That's why I'm very scared about stocks that don't have huge valuations, huge volume, and are in late stage basis. I just want to stay away from it. And then when they show these dreaded H patterns, when they're breaking, you see this death cross here? There was a death cross, and I even talked about that on September 6th. I'm like, you have to heed that there's a death cross. Look at that right there. Boom, death cross. And death cross basically means there's a lot of selling. And it's a self-fulfilling prophecy on Wall Street. People are like, oh my God, a death cross, that better sell. And more people sell, and it keeps selling and keeps selling until it finally bottoms. We are nowhere, I don't think, near a bottom on SMCI. I think there's a lot more pain ahead. Please be careful. If you're selling cash secured puts, I'm sorry. Sometimes it's not the best strategy, but you could sell calls against it to work your way out of it. It's probably going to take a year, though. I got to tell you. Sometimes these stocks, you got to be careful, and you got to read the charts. You can't just read the news, right? Sometimes that's why I read the charts and put these videos about it up. So if you recall and I'll shut up in a second, but if you recall in my strategy, it's to buy the right stock. Well, SMCI was the right stock when NVIDIA was going up because it was riding the coattails of NVIDIA. NVIDIA is not really going up anymore. It's at its all-time highs. It's trying to break out, but it's not doing a great job at breaking out. Why? Late stage base. So then this company was like, oh, we're doing really well, and management starts to get cocky and they do stupid things. And so that's what's going on probably with the accounting. I just don't like to be in stocks that are bad news stocks. So it's got to be the right stock. I'm not sure SMCI was the right stock unless you're on the short side. In the right market. Well, we're in the right market. It's yellow today, actually, but it's a good bullish market longer term. At the right spot on the chart. And there is no spot on the chart in the last, 8 months that you could say is a good spot to buy SMCI. And I know a lot of people that bought SMCI, but there wasn't a good spot to buy it. So you shouldn't have been buying it. You shouldn't have been getting excited about it. And then we squeezed the juice. Well, there wasn't a lot of places to squeeze the juice, although the juice was really good on this because it was so volatile. If you were squeezing the juice on the downside, hoping that it didn't drop to your price and you started wearing SMCI by selling cash secured puts, then you probably got a good amount of juice, and now you've lowered your cost basis now that you own it. But you got to have the four cornerstones. So look at stocks that have good volume, good growth, aren't doing shenanigans at their company, have good products, exciting products, things like that, and you'll be better off. Listen, that's enough for me. That's SMCI. I hope that helps you, but I want you to start looking at the charts and starting to recognize some of these patterns because they could save you a heck of a lot of pain. I'll see you on the next video. Take care.